Hi there, and welcome to the introduction to the Forex Masonry trading system. Now, this is the Forex Masonry system as we have it as a template. And what I would like to do in this video is I'm not going to go through the rules so much. There's other videos for that. What I want to do in this case is explain why we have what we have here. Now, I like to refer to the Forex Masonry system as naked trading with indicators. And you're going to see why I say that. Now, the foundation of, I think, any trading should be an element of naked assessment. You want to be able to look at the market for what it is without the clutter of the different indicators and make some really unbiased judgments, indicator free. And with that, what I'm going to do is start applying some indicators to give me ideas, better ideas of potential. So let's take a look at the beginning. We're going to delete all of these different indicators, and I'm going to start right at the very beginning here. So what I've got now is a naked chart. This is a chart that has no indicators on it. And this is the chart that we can trade. We can trade this naked chart. The market is making its moves. We're seeing its motion in real time. We're not getting anything that's delayed or what a lot of traders like to complain about, lagging. And by the way, lagging indicators lag on purpose. They're supposed to. We'll get into that one later though. Now, what we're seeing is the raw data. And a lot of traders can trade the raw data, and you're going to be able to as well. You're going to be able to trade exactly what you see and not what a set of indicators are trying to tell you. And there's a huge difference there. Being able to trade what you see is where really the money is. You're going to make more money, have less confusion, not so much conflicting signals when you can look at a naked chart like this and make some decisions based on what it is that we're seeing. We're going to be drawing trend lines. We're going to be looking at support and resistance, but then we're also going to add in the indicators that are going to act similar as tools like trend lines, like support and resistance, but they're going to be indicators that you're already familiar with that serve more of a unique purpose. All right, so if I take a look at this current time frame, this market move down is entirely expected. This is what we want to see. We want to see that this market moves down. Now, this is a tradable move. This is something that we could be taking advantage of on a lower time frame. Now, how do we know that that's the case? How do we know that the market is going to come back this way? Why won't it just keep moving up and up and up? That is a great question. We are looking at market that is a little bit overextended and needs to come back and correct itself. But how do we know this? We're going to apply our first indicator. It is going to be a 34 EMA, exponential moving average. So I'll add the moving average. It'll be a 34 of the close. And I do like to shift it a little bit. That way, if I shift it one, we don't get any repainting. And go solid line. So this becomes a baseline. And that's what I refer to it as, is a baseline. And if I take a look at this, what we can see is the market moves away and then comes back and then moves away and then comes back and then moves away and comes back to the 34 EMA. Now, you can try different moving averages. The 21 is a good choice. The 55 is a good choice, but the 34 is the one that I've tested, and I always come back to it because it seems to be the most dynamic, reactionary. It seems to hit the nail on the head, as it were. Now, this is a 34. If I go for a 21, we can see in areas like this, price tends to get through it a little bit more than we'd initially like. If I go with a 55, price starts to get towards it, but doesn't quite reach it. Now, if I go with a 34, we can see that price gets to it and uses it quite dynamically. It does bounce off of this fairly regularly, over and over. So the 34 becomes really the most attractive version of this. And to get back to that question here, how do we know that the market wants to come back? Well, the market tends to have these repeatable market movements. It will get beyond the 34 EMA by a certain amount of pips, and we'll measure it. We'll take a look at this. We'll use the crosshairs. How far does this one go? This goes 80 pips. How far is this one? This one is closer to 60. How far is this big one here? We've got just about 60 pips there. This one here, market gets 50 pips. We'll take a look at a few of these. So we've got 60 some odd. This one is just about 80 pips. We're looking at just about 70. Here we're looking at, again, almost 70. So these are repeatable. We're seeing that the market gets away from this moving average between 60 and 80 pips as its outside range. Of course, we're going to get these smaller moves away, but when we get a move that's between 60 and 80 pips, the market will want to return to the 34 EMA. And if we take a look at this one, how far away did this go? This one went 88, almost 90 pips, which means we are clearly overextended. In recent history here, looking back, we never got a move that was 90 pips away. It always was a little bit less. It was 80 pips, between 60 and 80 pips, and then the market wanted to return. And that is how we're going to determine if the market's overextended and wants to come back again. We're not using the 34 EMA to give us any signals or anything like that. We're using it as a baseline. We know from experience over and over that the market wants to go away from the 34 and then come back to the 34. And with that, we're going to start making some trade assessments around that knowledge. So up in this area, I'm looking for opportunities to trade towards the 34. I hope that makes sense. So I know that long trades, when the market's overextended, are not a great idea. We have an overextended market in this area here, and any long opportunity that we get, any trade to move up, just is very, very short-lived. The market does not want to keep going. And down in here, once we start seeing that the market has moved quite a bit and is starting to get overextended, any short move beyond that is going to be short-lived. It's just not going to be a very substantial move. So we're looking for those kinds of filters now. I'm going to be looking for reasons or opportunities or signals or setups or whatever the case is to come back to the 34. Now, that is why we're going to use the 34 EMA. I know that the market wants to move away from the 34 and then come back to the 34. When the market moves away from the 34, we are going to see the biggest market movements. They are going to move the farthest when they are trying to escape the 34. The 34 acts kind of like a magnet this way. It is going to push the market away, and then it's going to pull it back again. So when we get trading opportunities around the 34 EMA, I know we do have potential for a really nice trade. When we have a trading opportunity when the market is away from the 34 EMA, we've got a nice trade, but it may not move quite as far because I know that it's going to come back to the 34, and at that point, we're going to do some reassessment. Is the market going to push through it? Is the market going to bounce off of it? Or whatever the case is. But once we are looking for an opportunity to move away from the 34, oftentimes we can get beyond the previous swing highs or the previous swing lows and see a market that can move substantially. So that's why we're using the 34 EMA. Now, I like to use higher time frames in my assessment as well. So if I'm taking a look at this, this is the 1 hour time frame. My higher time frame is going to be the 4 hour time frame. And the 4 hour time frame, get rid of that for now, the 4 hour time frame also has a 34 EMA on it, and the price is going to do the same thing. It is going to move away and then come back to it, move away and then come back to it. And we see that over and over again. The market moves away and it comes back to it, moves away, comes back to it. And it's going to do that on every single time frame that we're willing to trade. So if I do the same thing here, market is 130 pips away, market is 130 pips away, market is 90 pips away, we're looking at 130. So all right, so let's see, where are we now from here to here? We're at 110 or so. So we are right in that area of overextended market territory. So we know that the market is very likely going to come back to its own 34 EMA. And this is the higher time frame, mind you. So I know that at this point, the market on the higher time frame is likely going to come back to its 34 EMA. Now, I like to switch back and forth between time frame and time frames, but when I am looking at the 1 hour, there is something that we can add that gives us that next higher time frames point of view, and that is adding a 4 times moving average. This is the 34 EMA. So if I add a 136 EMA, I'm going to do this dashed line so that it looks a little different. This is the 34 EMA on the next higher time frame. The next higher time frame, I want to keep the ratios as close to 4 to 1 as I possibly can. And 4 times 34 is 136. And let's prove that here. So if I go to the 4 hour, this is the 34 on the 4 hour. I'm going to draw crosshair on that. All right, let's thin that up a bit so it doesn't get in the way. So I've got my crosshair on the 34 of the next higher time frame. So if I drop down now to the 1 hour, that crosshair should be on the dashed line, the 136. All right, so if I do that, we are at the 136. Now, you have to keep in mind that there is 4 candles on the 1 hour chart for every 1 candle that happens on the 4 hour. So what we're looking at is probably a candle right in here or in here. And if that was the case, then we would see. So let's go back. So it's still on that area. So we are looking at the evidence that this is a reflection of the next higher time frames, 34. And the same properties apply. When we have the moving average on the higher time frame, price is going to want to get away from it. It's going to want to come back to it. And we see that here, here, and here. Like there's instances or examples of that all over the place. The market wants to come back and then use those next higher time frames as a target. Market will be drawn to it. Market will be repulsed from it. But when we put the two together, when we have the 34 and the 136, what we see is the development of a bias or of a trend. So when we have the 34 above the 136, we can be fairly certain that for the most part, the market is going to move in the trending direction further than against the trending direction. So when we have an area like this where we have the 34 above the 136, the market is going to make bigger moves in the trending direction than the moves against the trending direction. So we have a bias, and I like to get a bias as often as I can. If I can trade with a bias in mind, I know that we have some really good potential to move in that trending direction. Of course, every trend does come to an end, and then the bias starts to lose its momentum. And we're just not going to get trades that move quite as far. But this is all going to be part of market assessment. We're going to be able to see these as they start showing up. Now, when we look at the next higher time frame, we want to be aware of something called a halo. Market can get very close to the moving average, but not quite touch it. We'll take a look and see if I can find a nice example of that. So we can see that the market gets close to the moving average, but doesn't quite touch it. Gets close to the moving average, but doesn't quite touch it. And this is still a market that's being affected at these levels, but there is a bit of a halo around that. And the higher the time frame you go, the broader or the wider this halo becomes. And a really nice way to combat that is to take this moving average for the next higher time frame at least, and not use the close as much, but use the high and the low. And if I do that, I'm going to form a channel. This is the next higher time frame baseline channel. So if I'm looking for a short trade, there is good reason to be targeting the top of that channel. If I'm looking for a long trade, there's a good reason to be targeting the bottom of that channel, especially if they are counter trend trades in nature. Trying to get the market to get all the way to the center line, market does, it gets there, but not always. And if I can target the bottom of the channel in a long trade, then I'm more likely to get my profit target hit and be taken out of the trade, and then not have to worry that the market may pull one of these things and then change. Because if we are trading with the trend, or if the market is trending and we are taking a trade against the trend, there's a good opportunity for it to turn around and then just keep going and going. And nobody wants to take a trade, almost get your take profit hit, and then just see you get stopped out of it in a market that really is relentless. Now, with that, I have an indicator that cleans this up a bit, because I want to have my charts as clutter-free as I possibly can. So I'm going to have this high-low histogram. Now, this is the indicator that does all of that. So if I have the input, that should be 136, just making sure. All right, so this is the high-low histogram. Now, for the purpose of the manual, for some of the videos, I may keep it this color. But what I like to do generally is I'm going to lighten it up a little bit. I want to make the gray much lighter. And the reason for that is I am still trying to accomplish my naked trading. I still want to trade the market as I see it. I don't want my indicators to be a distraction. So I'm going to keep them fairly light. And if I can keep them fairly light, then they're not going to influence my decision making or make me not see something that I should be seeing. I can focus a little bit more on just the candles or the chart itself. I actually have a template for that. It's my basic white template where there's nothing on it at all, just the chart, just the price. And then I can take a look at that, then reapply the Forex Masonry, and then from there get some better ideas of potential where the market can go, what the directional bias is, and so on. All right, so with this, I have a bias. I know how far the market can potentially go. I know what direction the market is likely going to take off. I know the zones where the market is going to have the biggest potential. When we're at the 34, the market wants to move. When we're away from the 34, the market wants to move in the opposite direction, but maybe not quite as far. So we've got these tools in place. All right, so far they're not giving us signals, they're not giving us entries, they're not telling us any more than the potential that the market has. And that's really the way we want to do this. We want to keep those trading ideas and concepts, to us. We want to be making the decisions, not the trading system. But if we can get a hand with some of those ideas, like the 34 and the 136, then we're going to take that and use that in conjunction with our trading assessment. All right, so the next thing is, if I get a trade, a signal, I want to manage that, and I want to see, what is an actual signal? Is there an actual signal or a candle formation or something that will get me into the market? Now, there's something that I've been using quite a bit, and that is a channel. I like to use a simple moving average channel, and I'm going to put one on here. So we'll go, we'll make it magenta, all right, of the low, but I'm going to go 8 simple of the low, we'll hit OK, and that gives me a simple moving average of the low. We'll add another one. This one is going to be of the high, So that gives me a channel. And when I have this channel, now this is one that I've tested for years and I always come back to it. It's one of my favorite ways to do a couple of things actually. I like to get into a trade using this, and I like to use this to trail my stop loss. So when we get, say, an opportunity to go long like we do in here, when the candle closes above the upper channel wall, then we have some market momentum. The market's actually got to move in order to do that. And we get this nice bullish candle here that closes above the upper channel wall. And from that, in order for that to happen, in order for that to be the case, we need to have some movement from the market that proves that it's committed to that movement. And that move above that channel wall really is that commitment. And we're going to often see that there is some kind of candle formation or even a chart pattern that can accompany something like this, and it really does quantify an entry. It does make a good quality entry. Now, the same thing can be said for the exit. When we get this nice big move below and I'm looking for a short trade, maybe I'm targeting the higher time frames, 34 or the 136, then, or this is what we call the high-low histogram. We could use this channel to manage the trade. So for every new candle that opens, we're going to get a new section of channel. And for that new section of channel, I'm going to move my stop loss. And that is going to eventually take me out. So either the market is going to hit the target, or I'm going to be taken out with my stop loss. Now, this gives us an awful lot of noise. Now, I don't like the noise. I don't like clutter on my charts. So I'm going to get rid of this, and I'm going to introduce an indicator that does the exact same thing. And what that is are the dots. So this is my dot indicator, and we'll go dots. Okay, so I'm going to make those a little bit bigger. Again, they're small because I do like the lack of clutter. So if they're little, they're not really in the way. And this is the exact same indicator. So if I add the moving average back to it, inputs dot shift, we'll make it 1. All right. So now we've got the dots following that moving average. And if I add the moving average to the low, we've got the dots following the moving average underneath it. So this is the 8 simple moving average channel. Just going to get rid of these moving averages again. Come on, moving average. There we go. Delete and delete. And now I'm not going to use a shift on this because the repainting aspect isn't a huge deal. Because we're using the highs and the lows and not the close or the current price, the repainting of this indicator is rare. It's not something that we're going to see a lot of. Now, if you want to give yourself a little bit of room or a little bit of space or pull them away from the candles themselves, you can move the shift forward. But again, this is something that we're going to discuss at length inside the different sections in the forum. The 8 is great for the short-term movements. If you want the market to get from point A to point B, fairly straightforward, then this setting is really nice. You can increase this setting to 13 to 21, anything you want. The bigger the setting, the smoother it's going to be, and the farther away from the price is going to be. So if you want to have a market that has to move a long way in one of your trades, and you want to accommodate for some zigzag and some price action, then you want to have a setting that's a little bit broader with these dots. And again, this is something that we're going to cover more at length. But currently, the way the Forex Masonry system is set up, it is an 8 simple moving average channel, and they do give us really nice entries, and they do give us really nice exits if you want to trail or exit the trade that way, and they do give us really nice method to trail the stop loss. So this indicator is really robust that way. It does an awful lot of different things. Now finally, finally, what I'm going to do is add the MACD. And it's one of my favorite indicators, so MACD 2 line. Now this is the default one that comes with it. It's the MACD 2 line. This is part of the package, your masonry package. But this isn't quite what you're going to see. Now, I like to use the histograms and not so much the MACD line. Now you can choose the MACD line. It will serve a purpose as well, but I prefer just the histogram. So what I'll do is click on that. Under inputs, I'll show lines to false. Under colors, I want to make the line not so in my face. I want to not get a headache. So we'll go green. And now I have just the histogram. And what we've got here is the template. This is the Forex Masonry template. So I've got these in funny orders because the way I've applied it. So if I go to the Forex Masonry, there we go. This becomes the template. Now the MACD I'm going to use for a couple of different things. I'm going to use the MACD for divergence. You know, an example of that could be right here. We've got a high followed by a higher high. We've got a high followed by a lower high. Now we have that divergence in here. Now don't worry that this peak isn't green. You can see a white peak in here. It's simply a cutout of the red. But this peak is lower than this peak. So we have regular divergence at this point. And that is a nice indication that the market momentum is starting to fail. And if the market momentum is starting to fail, we're generally going to see some kind of reversal. Now, I use the MACD for this kind of thing. I will never use it as an entry signal. I'm not going to use it to get out of a trade. I mean, that's not what I use it for. I'm looking at strength and weakness behind the scenes. Now, the MACD gets to see the math maybe in a way that we can't. So we can see the market moving, but the MACD sees it purely as numbers. And when it sees it as numbers, it can see weakness where maybe we can't see the weakness. It can see strength where maybe we can't see the strength. So we are going to start using this MACD to give us maybe an insight to what the market is potentially going to do. Now again, there's another example of some divergence in here where the market does fall down, and this becomes a nice tradable move, something that we can take advantage of. Now we're going to use regular divergence. We're going to take a look at hidden divergence. We're going to take a look at non-divergence. And there's a new concept as well. And it's not something that I've given a name to yet. I'm still kind of trying to figure that out. But it's more of a directional momentum. And it's not 100% divergence based. I'll show you an example of what I mean. We can still see market movement that's being illustrated with the MACD and not be divergent. So let's take a look here. Now this is non-divergence. Market makes a low, makes a lower low. MACD makes a low, makes a lower low. Now when the market changes direction, it's often going to be divergent. So what that means is if the market's going to change direction and be divergent while doing so, that it still has to make another lower low with a higher low on the MACD. So if we get this non-divergence, we can assume that the market wants to at least meet this low. So it's going to have the pullback and then come back down to meet that previous low. And generally it'll get a little bit lower because we're looking for divergence. So that is just a sneak peek behind non-divergence. And then what else are we looking for? You know, an instance like this where we have a market making a higher low and the MACD is also making a higher low. Now I have found that this MACD is a great sign of what's happening in the market, regardless of what the candle structure is actually doing. Now, if I have this low followed by a higher low, if I have a lower low in the price, I have hidden, or I have regular divergence. But if I don't, this becomes, it's just not divergent at all. But what happens is the market does tend to want to move. So I'm taking a look at this setup here, this arrangement showing the mathematical lack of momentum, or the opportunity that the momentum wants to change. So I'm going to be paying some attention to how these are sloped, and maybe less attention to how the highs and the lows compare to the MACD. Now, this is something that we're going to get into more detail, but this is an approach that we're going to be using the MACD with. So we're going to be looking for regular divergence, we're going to be keeping an eye out for hidden divergence, we'll be looking for non-divergence, and we'll be looking for this kind of momentum of sorts, or the lack of momentum, or a change of direction in momentum. But this is what the MACD is going to be a good tool for. So that's essentially the Forex Masonry system. Now, the system itself is very, very functional, and everything serves a purpose. It gives us an insight to the market. Now, what we want to do is take that insight and apply killer assessment techniques to getting the trades. Now, we're going to use an awful lot of trend lines. We're going to be using support and resistance. I'm going to make sure you're aware of candle formations and chart patterns and things like that. But 90% of my trades are going to be using support and resistance and trend lines. Trend lines mostly. But we're going to cover all kinds of aspects. We're going to be looking at all kinds of ways that you can enter trades, trail trades, manage them, get out of trades, things like this. We're going to use predominantly naked charts and the Forex Masonry template. Now, the template that I generally like to use, again, I lightened this one up, and I tend to do that with these dots as well. So with the dots, I want to go this really light pale green and this pink color. And what they do is almost make the dots disappear. Now, I can see them if I'm looking for them, which is really the point here. I can see them if I want to see them. Otherwise, they're not getting in the way. They can stay in the background, they can stay fairly subdued. Doesn't much matter about the MACD, what color that is, because it's not getting in the way of the charts themselves. And what I'll do is be switching back and forth. I've got this basic white, and I will take a look at the market this way. Now, this makes sense. We can see what's going on with the market. I can draw some basic trend lines. I can refer to higher time frames. I'm going to be zooming out. I'm going to be looking at a broader scope if I can, and then I will go back to the Masonry template, and then I'm going to use that extra information with the moving averages, with the higher time frame, and so on, to get a really locked in solid idea for my trade signals. Now, taking this approach is going to simplify your trading, and I don't expect you to get this right away. I really don't. You're here forever now. You've got a lifetime membership, so you have all the time in the world to get this. Now, I am going to be putting videos out all the time, consistently, and they're going to be examples of how this works, just over and over and over. With this, you're going to find that you have more trading opportunities, that you're not locked into one direction, that you know how far the market can potentially go, that you know which way it's most likely going to go. You have the access to a cleaner system. You're going to have more reliable signals. Your trades are going to be more profitable more often, and everything is just going to be better. Like, the whole idea of this is to teach you how to trade, not to follow a trading system. Trading systems are often difficult to understand. They're a little bit black box. Sometimes you don't know how the indicators work and so on. This isn't the case here. I want you to understand how everything works, why you're using it, what they're for, and what kind of interpretation that you can get out of them in order to make your trading profitable. Now, if this seems a little bit overwhelming, please don't worry about that. You're going to find that it's easier than you think. And it really is. Trading does not have to be a difficult prospect. We don't have to be worried about it. You don't take trades that don't make sense to you. Take the trades that do make sense. You take the ones that you're comfortable with. If they, if you're looking at a market and you just can't make heads or tails of it, don't feel like you have to trade. You really don't. We're in a position to cherry pick the best trades. So we can pick and choose any trade that we want. And there's going to be times where you're sitting in front of your chart for your period of time, your window, and there's just nothing that you like, and that is okay. There are often times where I will sit there for hours and just nothing appeals to me and I won't take a trade. I don't get anything that I want to see, so I'm not going to trade. And that is fine. That is work, right? The fact that you are taking a trade, I mean, that's great that you're in a trade and hopefully it turns out for you and you make money this way. But the work itself isn't the being in the trade. The work itself is finding the trade and then managing the trade. That's the work. So if you do work and you don't get into a trade, there's a good chance that you've just saved yourself a percentage of your account. If you're trying to force a trade that's really not there, you don't understand the market, it's making noise that you don't quite feel happy with, and then you take a trade, that work is essentially out the window. Like you're gambling at this point. So seeing the charts, making the assessment, and then not finding a trade you like is a job well done. And it's really important that you understand that. You don't have to get into a trade immediately when you sit down. Now, with this Forex Masonry system, you're going to find trading opportunities all over the place. You have more than one currency pair to choose from. This works on all the different time frames. This works on all the different currency pairs, and you are going to open up the horizons, as it were, after you learn how to do this. And again, it's not going to take that long to learn this. And after you learn how this works, why you're taking trades, why this works and why that didn't work, you'll never look at another trading system the same way. You'll never be as blind to just the rules of the system. You'll be able to integrate all of these different aspects. Now, I'm not saying I want you to go and check out a different trading system. I want you to get good at one system, and if this is the one, awesome, because this is the one we're going to focus a lot on. But I am going to make available to you several other trading systems. I know traders love trading systems, so I'm going to make some available to you, and let's go from there. So I hope this video was good. I hope you enjoyed it. I hope it makes sense. Every aspect to the Forex Masonry trading system serves a purpose, and it is going to do what you want it to do, and you're going to do really well with this. So I'm going to see you in other videos. I'll see you in the members area, and I hope to talk to you really soon.